Sunil Subramaniam joins us. Sunil, good morning. Thank you for joining us. Given where we were, let's say, at the beginning of December, where everything was at a high, market sentiment, retail participation, IPO excitement, valuations, everything was at an all-time high. After that, we've seen some shakeout, some skim from the top, a lot of course correction. Do you think markets are looking reasonable and we are set for a decent start for 2022?
I think so. Also because the big risk of the Fed event has happened. So markets, generally hate uncertainty. So I think the direction that the Fed was going to do, that caused a big change. I think in a way the Fed admitted that it got the inflation print wrong. All the rise in inflation, they had kept saying temporary, and finally they admitted that it was not temporary and announced the advancement of tapering and rate hikes. So I think with that uncertainty out of the way, December is generally a quiet month because fund managers go on leave, annual vacations. So it's generally a quiet wave. So I think January you will see them come back because now that's one factor that you need to track is the Omicron spread in the advanced world. See, India, we are getting worried with 300 odd cases and controlling it. But I think the real concern is in terms of how it's going to affect the US recovery. So if Omicron is going to cause a dent to the economy of the US, that's the only worry point for the markets. Otherwise, I think the taper has now been discounted. And I think in the rate hikes also, we have fairly certainty that middle of the year, you will see rate hikes happening. So I think that you're right that a lot of the correction has happened. Valuations are looking a little more reasonable. And I think from India's perspective, however, Nikunj, the budget remains the big event for which there will be some uncertainty in the lead up.
Sunil, so we are going through that phase that if Omicron spreads, which it is, if it impacts economic activity, Fed is not going to cut rates. They may not delay their, tapering. In fact, the Fed was very clear that this time, if there is a lockdown or impact on economy, it will have an impact on supply chain, which will stroke inflation further. So, could we go through this process of readjustment? The word which we hate to use, hyperinflation. It's not hyper yet. But if growth goes down and inflation remains stubborn, then the market valuations and positioning changes.
Yeah, I agree with you. And it doesn't need to be hyperinflation, Nikunj. Even if this steady inflation with lower growth, it's an indication of stagflation. So I agree that the biggest concern for the market is that inflation is high, but demand is not picking up because supply side inflation is high, thereby tying the Fed's hands. Yes, that's definitely a risk to watch out for. But I think the news on Omicron, while it's spreading rapidly, in terms of hospitalization and mortality, it's nowhere near the Delta or the previous waves. So I think economic impact, I still will feel that US is the last to introduce lockdowns. They hesitate because they are believers in the free world, of laissez-faire. So I would say that I expect the growth rate to slightly get tampered because of Omicron and inflation definitely because of supply side impacts. But I don't think that lockdowns will come and a severe another recession in the US or anything like that is likely to start.
Sunil, where do you stand on the way IT is outperforming? The naysayers are saying, "Bhaiya sab theek hai," but all the good news is in the price after the recent run up. We know it is growing, but markets have already pricing that in.
So it's a combination of the fact that liquidity needs a safe house to spend time in, right? Because the banking is a high risk space because lending is not picking up, interest rates are at slightly rising for their funding guide. So there is the risk around that. But IT is the one place, and same take another safety, two other safety packs, right? There's a consumption pack that is FMCG and take pharma, right? Both of these, the growth prospects are not very strong. So in IT, the safety comes from growth. See, historically, IT had a safety because they were in a Hindu rate of growth and they exports the weakening of the rupee was supportive. So that was the safety aspect. Today, IT is coming from a very different safety perspective. It is that there is growth and market is definitely betting that that growth will turn out better than what is being discounted. And I don't see a reason to doubt that. The extent of that growth pickup over the consensus is only the question because the world has fundamentally changed in a way that IT now has become the biggest spending part of any company, any big manufacturing, big services company. Their biggest spending is on IT, and there is an urgent need to rejig that. So IT gets the business from rejigging, and Indian companies have moved up the value chain. We are now in IT consulting, competing with the likes of Accenture and everybody else. If you look at the salaries that IT entrants are getting from the IITs into the IT sector, it's phenomenal. So demand and supply is telling you that IT companies see that business strong. They are willing to pay top dollar to get the best talent to compete there. So I think that if you read that footprint, right, I think the future for IT is good. And especially, it's not just a large cap IT. It's not those bellwether names alone. It's a range of IT across small, mid, and large. So I, for example, feel that as a safety bet, right, IT is still a good place to be in. And liquidity, obviously, whatever liquidity there is, will give that premium to safety. So I think that's what we're trading on in the IT sector.
Sunil, my apologies, little bit of cross connection here and there, holiday mood, Sunil. I guess Nantara and Aisha are just taking it slightly easy today. So Sunil, this time the Santa Claus is here. Will the Santa overstays extension till budget?
Tough one to guess on, because I think the budget, so far the indications are that the government is reasonably on track in terms of their projected fiscal deficit. I think the tax collections have been ahead of expectations. The big daddy in the room, right, the LIC IPO. There were indications that it's not going to happen, but the finance ministry is reassuring that it is slated to happen. So that newsprint, because that's over 1 lakh crores, and that's going to make a big difference to the fiscal deficit. The other thing is in terms of the news around the budget. Is it going to be tending towards populism with the elections, 2 big elections this year slated on the thing, or is it going to continue to be reform oriented? So this uncertainty around the budget means that whether you see your question on whether Santa Claus will remain till the budget depends on the noises that the government puts forward. If the good government puts forward a good, positive, reform-oriented, kind of feelers before the economic survey numbers come out that way, then yes, Santa Claus can be there in the pre-budget rally.
Good morning, Sunil. Apologies for the
morning.
technical problem. My line actually got disconnected with our production control room. Good to have you today on the Christmas Eve special. I was hearing what you were saying about IT, how IT will come back, look at the engineers. I don't think they have a choice what they pay for them. Even Elon Musk is taking to Twitter to find engineers. But you also made this point. How can you have the kind of growth in FMCG which you're having in IT? Would you stay far away from FMCG? This is also a week when we've seen Godrej Consumer, for example, talk about double-digit volume growth. You've had Hindustan Unilever's Mr. Mehta also talk about, okay, inflation might impact volume growth temporarily, but it is just going to be a temporary phenomenon, a short-term phenomenon. The question is, would you stay away from this back as consumption returns?
No, the issue, Nantara, is not that I doubt the demand forecast. I think that the margin pressure and the fact that, if Omicron is going to spread, right, the first impact will be on this sector. So that uncertainty around Omicron. Second, the supply costs, how far can they pass it on to the consumer in this period, right? So their margin pressure. The third is that because they are part of a safety pack, right, liquidity tends to favor that pack independent of the results. So the valuations then tend to get a bit stretched and rich. So I would say temporarily, yes, I'm underweight on the FMCG pack. I would like to wait and see how the things pan out. On consumer durables, though, within the consumption pack, the discretionary part of it, there I'm slightly more bullish because I think 2 summers we have lost there, the first lockdown and the next second wave. So I think this summer could be a return for the consumer durables pack. So within consumption, I'm only saying underweight on the FMCG pack.
Okay, fair point. So that's your reading as far as FMCG goes. What about banks? We've all been waiting for banks and saying banks ka time kab aayega. So how are you approaching the financials, especially when we head into the new year?
So for me, the banking system is a four-pack system, right? There's the private sector banks, good quality private sector banks, which are largely retail oriented. Then there's the PSU pack, which is largely corporate oriented, but also always suffers a discount to the private sector banks. Then there's the NBFC pack, right? That's the lending, which is in the last mile lending, right? And the fourth pack is the other financial services, which are not necessarily lending, wealth management, asset management companies, insurance, and the pack. So that services, the last pack I'm bullish on because I believe that India's growth story in terms of the demographic dividend will play out. And you're seeing that in the mutual fund inflows, the SIP flows, the stock market entry. So I think that's a good pack to be in. I'll be cautious still on the PSU banks because I still think that unless real growth comes back, they are not going to be able to translate their lower CASA into the real earnings. So the big private sector banks, which are retail oriented, right? And the NBFCs, which are well capitalized at the top, I still remain bullish on them. I think the correction that's happening there is because they enjoyed a large part of the liquidity rush because they are about 30-35% of the indices. So any ETF tracking them has to buy the banks. So when there is pro liquidity, the banks tend to get a reasonable share of that liquidity, hence their valuations go up irrespective of the business outlook. And then the liquidity pulls off, the reverse happens. But if you look at it from a perspective of the next, say, 18 to 24 months, I see economic recovery definitely on track for India, and that can't happen without support from the banks in terms of lending. So for me, banking remains a buy where you consistently acquire banking stocks right through this phase. Every correction is a buy on dips for me, and ultimately, I think that the banks will be the winners in the capital markets because in a time when lending is at fixed rates, and borrowing is at floating rates, right? For the banks, essentially, the very limited 10-year fixed rate borrowing the banks do, but the lending is generally fixed, right? Because of the soft money they've gotten, and a lot of them are using this to lock on to rates for a longer period. I think the net interest margins of banks are set to widen as the economy recovers. So I'm overweight on banks, especially the quality with the quality filter that I just explained in terms of capitalization and good provisioning norms for NPAs.
Sure. Sunil, what about the realty rally? Is it close to peaking out, or would you say good times have just about begun? Because inflation is, impacting the real estate sector as well. What with the spike that you're seeing in cement, steel, and even labor costs, for that matter.
Yeah, but I think that they can pass this on. I know input costs are going up in real estate, but I think that fundamentally the government support for housing and real estate as a sector is going to continue. And the budget, I expect it to give a lot more swaps to that sector because employment generation, that's the biggest sector to satisfy the employment generation, which is a key election mudda. If I may speak that, in the run-up to the elections, employment is going to be the biggest factor. And I think the real estate cum housing sector is the biggest employment generator in the country, and the government will, in as many ways as possible, support it. So that's number one. Number two is, with the pandemic itself, you're seeing the people's desire to buy second homes just outside the city. People who are working now from their hometowns in rural India because of the new pandemic, that's kind of given acceptable now. They are buying houses there. So I think apart from the big metros like the NCR region or in Bangalore, you're going to see real estate development really widespread across the country. The third is that I still feel that from a consumer perspective, real estate is in a very sweet spot. So if you're going to take let's say a 20-year housing loan at 6.5%, you're in the 30% tax bracket. Your post-tax cost of a house is only 4.5%. Whereas your rental yield, even if they are 2 to 2.5, right? You're going to say that just putting 2% additional from my monthly income, salary or otherwise, I'm going to acquire a new asset. And real estate is perceived in the consumer's mind as an inflation protected asset class, right? Because generally over the long term, real estate prices do keep pace with inflation. So with that in mind, I think demand is going to be strong for housing and real estate, and even in corporate real estate, right? In corporate offices, you'll find now that a lot of the FDI that's coming in, so new corporate office space is being in demand. The initial fear that because people are working from homes. There's going to be excess capacity in the corporate space, has been belied now because all the PLI scheme and everything and the new things that's happening is created a fresh burst of revenue for corporate real estate. So to sum it up, I expect demand to exceed supply. And when in such a situation, any input cost price, I think, can be passed on to the consumer. So I'm not too unduly worried about the blip in the supply costs for the real estate. I think over a period of time that can get passed on to the housing buyer because the other factors are so strong for that sector. So I believe that in this wave, the cyclicality of the real estate sector is something which will lead to a positive EPS growth over what the market consensus is. And hence, wealth creation will happen in that sector.
Right. Okay. That's the take coming in on what we are seeing right now in terms of various stocks and sectors. I just want to quickly mark the markets before we move forward. 17,060 is where we're currently at. So definitely ebbed off a little bit. It's not so much about the index, but it's really what's going on with the broader end of the market, because that's where you've completely cooled off and now we're staring at a deep gash. It's a good 140 plus stocks which are now standing to the reds, with just about 4850 odd holding on to the green. But Sunil Subramaniam, such a pleasure having you on the show today, and here's wishing you a healthy and prosperous 2022 from all of us here.
Same to all of you from me. Thank you.